Hey there, future investors and market watchers. Get ready to cut through the noise because today we're talking about something that could absolutely reshape the global energy landscape and affect your portfolio. Imagine for a moment two colossal oil giants, deeply rooted in the UK, potentially merging. We're talking about BP, the company you know from gas stations and energy production, possibly being acquired by Shell. This isn't just a rumor. Reports from major financial publications like the Wall Street Journal have suggested Shell is in early stage discussions to acquire BP, sparking a frenzy of activity and sending BP's U.S. traded shares jumping. This isn't small potatoes. With BP's market valuation hovering around $80 billion, such a deal could be historic, potentially eclipsing even the monumental $83 billion merger that formed ExxonMobil. Shell, for its part, quickly denied these reports, calling them mere speculation and stating no talks are taking place. Yet, despite Shell's quick dismissal, BP stock initially surged by as much as 9.5% or even 10%, reaching highs near $32.94 in New York trading. While the stock price did retreat from its immediate peak after the denial, it remains significantly elevated, underscoring the serious attention investors are giving this possibility. Even before these recent reports, Bloomberg had indicated back in May that Shell was studying the merits of a BP deal. BP itself has remained silent on the rumors, opting for no comment. This isn't the first time BP has found itself at the center of takeover speculation. The company has underperformed its competitors for years, which has consistently made it an attractive acquisition target. 5 years ago, BP set ambitious goals to slash carbon dioxide emissions and pour investments into renewable energy. However, this aggressive green pivot came under intense scrutiny from investors as profits faltered, especially when global oil and gas prices soared and BP lagged behind. Earlier this year, current CEO Murray Auchincloth announced a strategic reset, essentially doubling down on the core oil and gas business while significantly curtailing spending on renewables. This shift, however, hasn't been a magic bullet for the stock's performance, which has continued to underperform in 2025. Adding to the pressure, activist investor Elliott Management disclosed in April that it had built a stake of more than 5% in BP, further fueling speculation that the company would face intense pressure to sharpen its focus on its traditional fossil fuel operations. Even Abu Dhabi National Oil Company reportedly considered a takeover in 2024, but ultimately did not proceed. But here's where the plot thickens and why any potential acquirer, including Shell, would need to think long and hard. BP's debt profile is seen by some analysts as something of a poisoned chalice. While BP reports a net debt of $27 billion, which is already higher than some of its rivals, a closer look at its financial disclosures reveals around an additional $38 billion in hidden liabilities. The largest chunk of this additional debt comes from approximately $27 billion in hybrid bonds. These financial instruments are tricky. They blend characteristics of both debt and equity. While they offer fixed income payments like traditional bonds, issuers can sometimes skip these payments, making them inherently riskier and more costly for investors. Unlike Shell, which holds no such hybrid bonds, TotalEnergies, for comparison, holds about $12 billion in hybrids. Furthermore, BP has $12.5 billion in lease obligations from vital assets such as vessels and rigs. Crucially, Shell includes over $28 billion of these types of liabilities in its reported net debt, whereas BP excludes them from its own net debt calculations. And let's not forget the lingering shadow of the 2010 Macondo disaster in the Gulf of Mexico, one of the world's worst oil spills. BP is still on the hook for approximately $8 billion from that incident, part of a staggering $70 billion total cost. And this remaining liability is also excluded from its stated net debt. Shell's CEO, Wael Sawan, has publicly argued that buying back Shell's own stock offers better value than investing or acquiring BP. And analysts largely agreed that BP's higher all-in debt load is a key reason. While BP shares might appear cheap at first glance, financial metrics that account for a firm's value compared to its cash flow generation, like enterprise value to debt-adjusted cash flow, suggest that BP is trading largely in line with Shell. This higher leverage significantly limits BP's free cash flow generation, making it a less attractive target than its raw share price might indicate. However, if BP successfully executes its $20 billion asset disposal plan by 2027, it could significantly improve its valuation and reduce its leverage. Now, let's look at BP's recent operational performance, specifically from the first quarter of 2025, which ended on April 29th. On the positive side, BP achieved strong operational performance with refining availability exceeding 96% and upstream plant reliability at over 95%. The company successfully started 3 major new projects, adding 100,000 barrels per day of new capacity towards its ambitious target of 250,000 barrels per day by 2027. They also made 6 new exploration discoveries, including a significant find in Namibia. BP's customers business delivered its best first quarter since 2020 on an underlying basis, indicating strong performance in its customer-facing segments. The company also reduced its capital expenditure by $0.5 billion for 2025, bringing it to $14.5 billion, with organic capital expenditure expected to be below $14 billion, excluding inorganic payments. In terms of divestments, BP completed or signed $1.5 billion and anticipates $3 billion to $4 billion in divestment proceeds for 2025, with the majority expected in the second half of the year. Operating expenditures were also down by $500 million quarter over quarter. However, there are also some notable negative points from the quarter. The gas and low-carbon segment missed earnings expectations primarily due to a weak gas trading result. Net debt rose during the quarter, mainly attributed to a working capital build, although this is expected to unwind throughout the rest of the year. The refining business faced challenges from difficult margin environments, particularly in the Midwest and Rotterdam regions. Despite a $1.75 billion share buyback program, BP's share count actually increased, partly due to employee share plans. And finally, the effective tax rate for the first quarter was approximately 50%, which is higher than previous quarters and certainly impacted the company's overall profitability. On a related note, Murray Auchincloth, BP CEO, sold over 336,000 shares of company stock in late May for a value exceeding $1.6 million, though he also made smaller purchases earlier in the spring. Looking ahead, Wall Street analysts maintain a hold rating on BP based on the consensus recommendation from 18 brokerage firms. The average one-year price target from 15 analysts is $33.71, with estimates ranging from a low of $26.50 to a high of $49. Guru Focus, an investment research platform, estimates BP's fair value in 1 year to be $33.75, suggesting a similar upside. This estimate is calculated based on BP's historical trading multiples, past business growth, and future performance projections. So, what does this all mean for you? The situation surrounding BP and Shell is complex, with conflicting reports and a highly leveraged BP. While the immediate excitement around a potential merger has pushed BP stock higher, the fundamental challenges, particularly its substantial and complex debt profile, remain. It's a classic case where initial appearances of value might not tell the whole story. The market is clearly sensitive to any news of consolidation in the energy sector, and this ongoing speculation highlights the immense pressure on companies like BP to adapt and deliver shareholder value in a rapidly evolving global energy landscape. Keep a close eye on further developments, as this story is still unfolding and could significantly impact the energy market. Thanks for tuning in, and remember to stay informed and make your investment decisions wisely. We'll catch you next time with more crucial market insights.